Okay, I'm going to spend my time talking about the meaning of the word liquidity, maybe a little unglobal. So liquidity and illiquidity are terms that mean different things to different people in different settings. So I'm going to find it helpful to sort through different settings in which liquidity or illiquidity are features of an environment or descriptions of activities or of exchanges. And I'll talk in terms of models. So the benchmark model, which is the Newton model of economics, has no role for liquidity because it works so perfectly. So this is the workhorse model of finance and macroeconomics, which continues to be the general equilibrium models of Arrow and de Broglie. So there are two variants, features of which set the stage for all subsequent discussions of liquidity. In both variants, there are no bilateral trades. All trades are multilateral. In that sense, they're global. Obligations are cleared by a Walrasian auctioneer, an entity that is outside the model, but that sets high-dimensional price vectors to satisfy budget constraints in clear markets. So there's two variants. The Arrow-de Broglie model with time-zero trading. So this implements the Hicks-Arrow idea to make, quote-unquote, dynamics and randomness a special case of statics under uncertainty. And the trick is to index commodities by time and histories of random events, and then just proceeding with general equilibrium as business as usual. All trades occur at time zero. At future dates, deliveries occur, but there are no trades. A telltale sign of an Arrow-de Broglie model is that there's one budget constraint for each agent. That's what Bob Lucas meant when paraphrasing or actually distorting Tolstoy's first words in Anna Karenina. He said, all complete markets models are alike, while all incomplete markets models are incomplete in their own ways. And that being incomplete in their own ways is the reason people use liquidity in different senses. In the Arrow-de Broglie model, at time zero, there's a vast clearing arrangement that we can imagine being affected by the Walrasian auctioneer who allows any trades that satisfy budget constraint. A big part of progress was Arrow's transformation of the model to implement sequential trading with Arrow securities. What Arrow discovered was a trading arrangement that supports the same equilibrium allocations as the Arrow-de Broglie model, but in which people trade fewer things, namely one period forward Arrow history contingent securities, but they trade them more often, every period, or in continuous time models, every instant. Arrow's discovery is a great illustration of a dictum that, quote-unquote, finding the state is an art. Two keys to sustaining Arrow's trading arrangements, which are still multilateral, they're not bilateral, are first, attaching to each consumer a time t history ht state variable that describes his past consumption savings behavior and his future obligations. This key state variable, which Arrow discovered, is the household's continuation wealth evaluated at continuation Arrow-de Broglie prices. And the second key discovery of Arrow was the need to ascribe some state-by-state borrowing limits for each household that assure that it is feasible for the household to meet its state contingent obligations next period. There's a vast number of these borrowing limits, one for each household, for each date and each history, for each value of a next period state in which payoffs contingent. Notice that a hypothetical auctioneer in an Arrow security economy has to name not only a price vector each period, but a vast list of vectors of one period borrowing constraints for each household. That auctioneer is very busy. Trading is multilateral, and the auctioneer runs a vast clearing system Still much smaller than for the Arrow-Debreu economy, but much more often. So here's a digression. In an Arrow-Debreu or Arrow economy, do assets trade for their quote-unquote fundamental values? It all depends on what you mean. The framework allows heterogeneous beliefs, so people can disagree about fundamental values. Do more accurate beliefs ultimately prevail? Bloom easily described technical conditions in which the answer is yes, but it can take a very long time. So in the Arrow-Debreu benchmark, all assets are perfectly liquid. There are no bid-ask spreads. There are no delays in executing trade. The Walrasian auctioneer, who actually lives outside the model, costlessly supplies liquidity because it's costless to supply. The multilateral clearing system works like a charm, and there are no limits to pledging future income. So now I'll describe some minimal modifications of the benchmark framework that open the door to liquidity, and then later I'll describe some more radical modifications. But that benchmark framework is always there. The transition from the Arrow times zero trading, Arrow-Debreu setting to the Arrow sequential trading sets the stage for an important class of models whose authors describe them as introducing senses of liquidity. These all use some device to tighten the borrowing constraints that limit trades of Arrow securities. Trade continues to be multilateral, but it is impeded by some enforcement or information friction. I call these modifications minimal. They're widespread. They're minimal because they assume that agents are as present or as connected as in the Arrow-Debreu model. What impedes trade is not locational separation, as in search models or in the Townsend Turnpike model, but something else. And the leading example of this class of models is the Keogh-Levine model. In the Arrow-Debreu model, contracts are assumed to be costlessly enforced. Not so in the Keogh-Levine model. Here, the same set of Arrow securities are traded as in Arrow's model, but contracts have to be self-enforcing. They have to be in the interest of all parties to adhere to. So to Keogh-Levine, this means that equilibrium allocations have to be arranged so that each household has the incentive to honor its contract at each moment, while always being free to walk away into autarky, or in the hands of Gina Cohen-Ray, into some other society of traders. Technically, what Keogh and Levine do is to tighten the history contingent state-by-state borrowing constraints in Arrow's model, tightening them in a way that embodies so-called participation constraints designed to capture enforcement difficulties and designed to make it in everybody's interest to honor those contracts. Keogh and Levine show many things about these contracts, how they lead to additional history dependence in allocations, and how they affect equilibrium prices. This has been applied in successful empirical work. In these models, an auctioneer still clears markets, and trades are still multilateral. There's no need for money or a medium of exchange. But there is a sense in which consumers' assets are illiquid. The amount of these can be computed state by state by comparing the borrowing constraints that Arrow would assign and the tighter constraints assigned by Keogh and Levine. You can regard Keogh and Levine's model as giving an elegant kind of non-pledgeable income. Notice that some assets, namely those of non-pledgeable income streams, are not priced in equilibrium, a kind of illiquidity. In models of the Keogh-Levine tradition, there's an enforcement friction, but no information friction. Now we move on to another kind of modification. These are models with repeated moral hazard. And these make big steps toward what you could call as liquidity. These are models of Thomas and Worrell, Phelan and Townsend, Atkinson and Lucas and others. They completely turn off Keogh and Levine's enforcement friction, but turn on an information friction. in which endowments or taste shocks are private information. And this setting gives agents an incentive to misrepresent their income or taste shocks. Then contracts, which here are often bilateral, are designed to trade off intratemporal insurance against intratemporal insurance against intratemporal consumption moving, with the outcome that neither one is perfect, as it is in the Arrow-Debreu benchmark, without the information frictions. As I say, in these models, trades are bilateral, and contracts are often exclusive between individual households and either a financial intermediary or a planner. I'd recommend looking closely at the Atkinson-Lucas model, which I regard as an elegant start on a dynamic Diamond-Dybvig model. Because if you look at the key shock in the Atkinson-Lucas model, it's exactly like the Diamond-Dybvig model. But Atkinson-Lucas can be regarded as a general equilibrium model, and it's also a model in which they solve for what the optimal arrangement is. There are extensions. There's models with both repeated moral hazard and enforcement, in which the quote-unquote liquidity problems get more profound. The ultimate source of bilateral contracts in these repeated private information settings is the ability of an enduring arrangement to improve allocations by trading off intratemporal risk sharing with intratemporal consumption smoothing. Here, banks or financial intermediaries do something important that outsiders can't. Namely, they preside over these enduring relationships designed to help information and insurance. Another thing, deviation from the Arrow-Debreu model, or you could view it as this very special case of an Arrow-Debreu model designed to destroy Arrow's theorems, is the overlapping generations model. That model arranges people in time and space in ways that are designed first to kill off the two welfare theorems, to open the way to welfare-improving equilibrium with valued fiat money, to give rise. Valued fiat money in those settings is an excellent and basic example of a welfare-improving bubble. Valued fiat money is worth more than its fundamental value, and that fact is intimately connected to its welfare-improving properties. There are other models that are cruder but important, such as the cash in advance model of Lucas, which is all about putting on restrictions which generate a liquidity problem and then having an optimal policy, namely the Freedman Rule, that solves the liquidity problem. I'll mention one thing that comes from these cash in advance models that's very modern to cure the liquidity problem, and that is the Freedman Rule, which requires paying interest on reserves. And there's a footnote on page 4 of Friedman's Program for Monetary Stability, which stresses the importance of how paying interest on reserves is financed. Is it by taxes, interest on the central bank portfolio, or printing money? And you know that since 2008, the Fed has the ability to pay interest on reserves. The legislation is silent on how it's going to be financed. Friedman stresses that paying interest on reserves is a fiscal, not a monetary policy, and that financing it is all important. Here's a question: do we understand how interest on reserves in the United States will be financed, and does it matter? Friedman would say yes. In multi-country overlapping generations models and cash in advance models, how many currencies is there room for? How many international currencies are there room for? With flexible prices, Carrick and Wallace exchange rate indeterminacy result shows that there's only room for one. Any martingale is an equilibrium exchange rate if there's multiple ones. The market can't pin down the relative prices of nickels and dimes or pounds and dollars if there's flexible prices. With sticky prices, there could be room for many monies. And how many and what they look like, it all depends on what the source of stickiness is, and our understanding of stickiness is very tenuous. Another what I'd call a minor modification is what we call financial accelerator models. Those can be interpreted as models with a multilateral trading as in the Arrow Debut tradition. The whole idea, and this is an idea of Bernanke and Gertler, is to tack on a collateral constraint to create a liquidity premium for assets that qualify as collateral. Deteriorations of the value of collateral impede borrowing and lending and denigrate allocations. This gives rise to liquidity premia for collateral-eligible assets. Collateral constraints, and here's one of the things that haunts these models, generate motives for precautionary savings to get out of to disarm the constraint. And that happens with high discount factors. It's a very powerful force. Anyway, collateral constraint models provide a cheap rationalization for government interventions to relax the collateral constraint, and they also give rise to models of good bubbles. In models with collateral constraints, bubbles can be good, and several high monetary officials have alluded to this. So now I want to mention bigger modifications. So these bigger modifications of the Arrow Debut model come from breaking the locational and temporal links that allow multilateral trading and clearing arrangements in that model. So what these models do, these are search models, high-frequency search models in the tradition of Duffy and his co-authors, and also Kiyotaki Wright, Neil Wallace. These models arrange meetings of people in time and space that are designed to make all trade be bilateral, and therefore make room for middlemen recognizable as liquidity providers. So in some of these models of Duffy and Weil and others, there are buyers and sellers of an asset who arrive randomly via separate Poisson processes. That's made up by the analyst. Prospective buyers and sellers meet bilaterally, and they might or might trade bilaterally depending on bargaining. These models, which ring true to people who are traders, have several classes of traders. And it's important to distinguish among them, and it's important for the participants in the model to know the other counterparty. They're sellers for non-fundamental reasons. These are reasons not collected to their opinion about the fundamental value of the asset: rebalancing, death, divorce, marriage. They're sellers whose opinion about the fundamental value of the asset has deteriorated. There's buyers for non-fundamental reasons. And there's buyers whose opinion about the fundamental value of the asset has improved. And then there's liquidity providers, and these people are middlemen. They buy into temporary decreases in prices caused by surges in arrival of non-fundamental sellers, and they want to sell into temporary decreases in prices caused by surges in the arrival of non-fundamental buyers. Their problem is liquidity providers want to avoid, or you could say front-run, traders who buy or sell for fundamental reasons. They don't want to trade with them, they want to mimic them. Meaning, trading for fundamental reasons means that people have opinions about the fundamental valuations of the assets, not that they've been hit by a liquidity shock. So intermediaries have incentives to figure out whether someone is a fundamental or non-fundamental trader. The size of trades can help infer that. The definition of liquidity that comes from this literature is something about the rates of arrival of buyers and sellers in terms of fundamentals, and something about the bid-ask spreads that emerge in these markets. And there seems to be a frequency domain specialization among dealers, with dealers, hedge funds carrying on basically the same activities but specializing in markets with different arrival rates. Liquidity providers earn returns for taking risk involved in inferring fundamental from non-fundamental customers. So here's a question. Are liquidity providers, or should liquidity providers be private, namely hedge funds, or public, central banks? So here's what many people would want. They would want limit theorems in which trading arrangements with these spatially separated agents turn out to approach Arrow-Debreu allocations as contact rates go to infinity. That's what a welfare economist would want too. So another kind of model in this tradition is models in the Keynote-Wright model, Keynote-Wright tradition. And here the question is, what asset emerges as a medium of exchange? And models in this tradition want that to come out endogenously. They want somehow the market or the agents to choose it, not the governments. And there an asset becomes liquid if it is used as a medium of exchange. Okay, so models of contagion. Well, I already mentioned the Atkinson-Lucas model. In different hands, Diamond and Divvig convert that into a model of contagion, and it's all about liquidity shocks and multiple equilibria. So I'm ready to just about ready to conclude. I want to give you some scattered definitions of liquidity, because that's a word that this conference is about. An asset said to be liquid, or the state of the market for that asset said to be liquid, if you can rapidly find someone to write a repo against it with a small haircut. So that's a contact rates are high definition. An asset's liquid, here's another definition, if its default rate is low. Here's another definition, asset's liquid if its bid-ask spreads are low. Here's another definition, an asset's liquid if people agree about its value. That's a peculiar definition, and you'll notice it may not be true in the Arrow-Debreu setting with heterogeneous beliefs. An asset's liquid if it's a medium of exchange. That's peculiar too, because in the Arrow-Debreu model there is no medium of exchange. An asset is said to be illiquid when its value is less than the discounted present value of its dividends. But whose stochastic discount factor are you going to use? And the property stressed in this definition is the opposite of the property of the asset as a bubble. Here's another definition. An asset is liquid when big trades don't affect its price much. The industry of liquidity providers and hedge funds its social value is to increase liquidity in that sense. And finally, an asset is liquid if its big trades don't have at most temporary effects on its prices. All these definitions are different. Finally, global liquidity. You can regard it all as a special case of what we talked about. It's global liquidity is the provision of insurance against exchange risk. Then you have to ask who or what generates exchange rate risk. Is insurance against exchange rate risk to be provided by private liquidity providers or by some government institutions? And are the government institutions that would provide the insurance distinct from the same government institutions contributing to exchange rate risk? Thank you.
Good morning, Governor Kim, Dr. Sargent, participants of the conference. It is my pleasure to speak before you at the outset of this conference on global liquidity in a global framework. This is indeed an important topic that has aroused renewed interest in recent years, particularly in light of the 2008 global financial crisis. Ample global liquidity has been singled out as a potential factor behind the pre-crisis accumulation of financial vulnerabilities. Similarly, in the wake of the crisis, liquidity has been at the center of the debate about the implications of general monetary easing in advanced economies. Discussion has focused not only on the immediate spillovers from particular measures, but also on the implications for global financial stability from a prolonged monetary accommodation. So In my remarks, I'd like to take a few minutes to by summarizing where the IMF sees the global economy at this point, where some of the major vulnerabilities and risks lie, and the policy challenges that need to be addressed. I will pay particular attention to the issue of capital flows, exchange rates, and the role that unconventional monetary policy in warding off global tail risks. I will then try to explain why the monitoring of global liquidity indicators is important and link global asset price developments with changes in global liquidity. So, first on global economic prospects. Almost 5 years have passed since the collapse of Lehman Brothers and the start of the global financial crisis. Unfortunately, the global economy continues to feel the aftershocks. Policymakers continue to grapple with the policy responses. The start of this year, as we all know, saw tail risks receding in the global economic scene, thanks partly to the policy actions taken in the United States and in the euro area. The financial market conditions have improved markedly across the board for the last half year or so, but the real economy continues to lag. We still are not seeing the levels of growth needed to drive a real global recovery, and we are not generating the jobs needed for the millions who have fallen into unemployment over the past 5 years. Our IMF outlook that we released in early April shows that the global economy is strengthening, but this is happening only little by little. Under our projection, the world growth is expected to reach 3.3% this year, improving slightly to 4% next year. However, the recent data for the first quarter of this year suggests a softer pace of real activity, underscoring the downside risks of global growth. For instance, activities in Europe shrunk more than expected, and persistent weakness in the periphery, European periphery, and policy uncertainty is increasingly affecting confidence in the core European economies. Among emerging economies, China reported sluggish activity in the first quarter, and investment in India, Russia, and South Africa, and others continue to be sluggish. Coming back to the broad global economic prospect, there is a significant divergence in prospects among countries. There are countries that are doing well, particularly among the emerging and developing countries. There are countries that are on the mend, such as the US, and there are countries that are still some way to go, including Euro area and Japan. We use the label 3-speed growth these days. Let's talk about each of these groups very briefly. First, emerging markets and developing countries. For the past decade, these countries have led the global recovery. Today, the two fastest growing regions of the world are developing Asia and sub-Saharan Africa. We are projecting that these regions grow at around 7% and 5.5% respectively this year. At the same time, many emerging economies, while recognizing the importance of unconventional monetary policy to support demand and contain risks in advanced economies, they have worries about adverse side effects. Policymakers in emerging economies have been concerned that this could affect exchange rates and capital flows and threaten financial stability through high asset prices and rapid credit growth. I will certainly return to this theme in a moment. The second group of the three-speed recovery is the countries on the mend. I will focus on the United States, where modest growth recovery is envisaged, about 2% this year and 3% in 2014 as the private demand firms up. The most recent indicators from the housing market has been most encouraging, although growth this year is still not likely to be strong enough to have a significant impact on unemployment. But it will be achieved despite the strong fiscal consolidation equivalent to about 1.8% of GDP. There is a real need for the US to help drive global demand. As long as Washington avoids another deep and sudden fiscal adjustment, a plan focused on medium-term adjustment can provide room for the needed recovery of private demand. The third group is the countries that are still lagging. As we all know, the recovery seems to be eluding some crucial economies, most notably the euro area, where we are forecasting a mild contraction of 0.25% this year. Germany's growth is strengthening, but it's still likely to be only about 0.5 percentage point this year. France's growth will be slightly negative this year, according to a projection, while Spain and Italy will experience a substantial contraction this year. European policymakers have accomplished many things over the past year or so, but there is still much to do. While these countries are adjusting, including through structural reforms, these measures so far have not compensated for weak internal demand, struggling banks, and absence of credit to drive investment and deep unemployment. The governments in the euro area must continue with the urgent task of fixing their banking system by promoting banks to repair balance sheets. This is crucial because the problems of the banking system are preventing low interest rates from translating into the credit needed to lift growth. The problems of the European financial system also require collective actions. I will not get into the detail here, but we are talking about bank recapitalization through the ESM, more comprehensive banking union that adds a single resolution authority or a common deposit insurance fund. Meanwhile, in Japan, which has faced a generation or more than a decade of economic stagnation, it is good to see the country forging a new strategy. Japan's new government has announced a three-pronged approach to revive the economy. These are higher inflation target with more aggressive quantitative easing, flexible fiscal policy, and structural reforms to raise long-term growth. Immediate actions have included setting a 2% inflation target with ambitious quantitative easing and fiscal stimulus of about 1.5% of GDP over the next 2 years. And this is reflected in our IMF's forecast of 1.6% growth this year and 1.4% growth next year. Japan's new approach has our support. However, given Japan's high level of public debt, fiscal stimulus without a medium-term plan for fiscal consolidation is a cause for concern. It increases the possibility that investors will require a risk premium, and it raises the specter of unsustainable debt further down the road. Moreover, it is key to also proceed with the planned growth-enhancing structural reforms to ensure that the complete policy package succeeds in delivering sustained growth over the medium term. Now let me turn to the issues related to some of the policy challenges that we are facing now. The continued problems in the euro area certainly create near-term risks. I talked about that. For emerging market economies, the primary challenge relates to economic forces they have limited control over. These challenges include weak demand from their traditional markets, talking about advanced countries here, managing the pressures from exceptionally loose monetary policy in advanced economies, and preparing for the period ahead when conditions normalize and the price of risk returns to more normal levels. So in this period of unprecedented economic turmoil, unconventional monetary policy has helped ease tail risks of a market breakdown. It has restored investors' appetite for risk and encouraged resumption of flows. Perhaps since unconventional monetary policy is a comparatively new instrument, its impact is not yet fully understood by all of us. As such, it may have occasionally added to uncertainty and fueled volatility in capital flows. These risks appear to be under control at this moment, but we must be alert to any warning signs. Some episodes of unconventional monetary policy have also been associated with appreciating emerging market currencies. However, the resulting drag on competitiveness needs to be balanced against the positive effect of stronger advanced economy demand, as well as potential terms of trade gains from high global commodity prices. To better gauge the impact of unconventional monetary policy, we have worked on various macroeconomic models. Our work suggests that a general unconventional monetary policy easing supports sizable output gains in advanced economies and some emerging markets. However, for emerging market countries that are already facing inflationary pressures in particular, the scale of this impulse can represent a sizable policy challenge. Moreover, in countries where the exchange rate has been allowed to appreciate, this has supported internal demand at the cost of exports, at the cost of export sectors. Now, let me turn briefly to the main focus of this conference today on the global liquidity. As I have said at the start, there has been much focus on this issue, but there is also a surprising lack of consensus on how it should be defined and measured. The common element in most definitions appear to center on the ease of financing at a particular point in time. This in turn is shaped by the macroeconomic environment, the stance of monetary policies, financial regulation, and other factors that guide the actions of market participants. Those factors include the pace of financial innovation and risk appetite. It has been typical to look at price-based measures to get a sense of liquidity conditions, including policy rates, as well as those from secured and unsecured money markets and swap and bond markets. But to supplement prices, especially when markets may not clear or when stability concerns arise, attention has also been placed on quantity-based measures. In times of turmoil, it is often useful to look at both price and quantity. Key quantitative measures of global liquidity have typically focused on the asset side of the balance sheet, and so have generally tracked the evolution of cross-border and foreign currency credit. Complementary measures that focus on the funding side of the balance sheet have also been developed. And this allows a system of classification that is particularly useful in exploring the financial stability implications of liquidity expansion. Specifically, it allows the distinction of core liquidity, which captures the use of traditional deposit-based funding, from non-core liquidity, which captures the use of securitization and collateral-based funding. Core liquidity approximates traditional monetary aggregates such as M2 and M3, whereas non-core liquidity measures the growing role of the shadow banking system. So, from a financial stability perspective, both asset growth and non-core funding are particularly useful for surveillance. These two measures are highly procyclical and may serve as variable signals of potential problems. In particular, asset growth reflects the cross-border credit extended by banks and other financial institutions that are often associated with the rapid buildup of foreign currency-denominated credit. It is this buildup that can turn around abruptly when financial conditions deteriorate. Similarly, non-core funding indicators can convey information about potential risk-taking in the economy. They can also tell us about the extent to which the global financial system is prone to sudden funding reversals following a change in risk appetite. Indeed, a key motivation for the IMF's funding side approach is the general observation that rapid system-wide credit growth in excess of deposits funded by implication through non-core channels is typically associated with the accumulation of financial imbalances. In this context, global liquidity trends may have global consequences. Recent IMF research has confirmed the general finding that rising global liquidity tends to boost emerging market asset prices. However, it has also found that a cross-country impact of changes to non-core liquidity is somewhat larger than for core liquidity, perhaps reflecting a key funding channel through which resources are allocated to riskier asset classes. In line with the accelerating pace of financial innovation, the largest and most procyclical component of global liquidity has been on the non-core or the shadow banking component. However, the global financial crisis resulted in a dramatic collapse in non-core liquidity. The elevated aversion to risk and the freezing of collateral-based markets forced shadow banks to sharply scale back their balance sheets. So in this context, a key role for unconventional monetary policy appears to have been to offset this decline by boosting the funding available to traditional core banks, resulting in a relatively flat profile for total core and non-core liquidity. In addition, many unconventional measures were aimed directly at supporting financial stability in specific market segments, such as targeted liquidity provisions to security firms and money market funds, and expansion of repo operations to commercial paper and asset-backed securities in the United States. Such actions helped alleviate fears about an even more catastrophic crisis, and they are likely to have eased the contraction of the shadow banking system, protecting the global economy from the impact of a full collapse in credit. So far, quantity indicators has provided little evidence of a return of excess global liquidity. From the asset side, the crisis resulted in a collapse of cross-border credit over 2008 and 2009, and since 2010, international claims have remained effectively stagnant. From the funding side, non-core liquidity continues to shrink as a proportion of GDP, and there is no sign yet of a rebound. So please allow me to sum up here. Unconventional monetary policy measures in advanced economies have supported growth, but raised important policy challenges for countries receiving the resulting capital inflows. These measures have been crucial to ward off, these unconventional monetary policy measures have been crucial to ward off global tail risks and reduce the output costs of the global crisis. They have reduced long-term interest rates, spurred growth, avoided deflation, and restored the functioning of the financial markets. But spillovers to capital flows raise important policy challenges for emerging markets, particularly those already facing inflationary pressures. Higher asset prices in emerging markets may be an unavoidable consequence of unconventional policies, but it is important to understand how these policies affect the volatility of prices as well as their levels. Clear communication, including through forward guidance, will help lower the volatility of capital flows and help recipient countries contain the volatility of exchange rates and other asset prices. As policymakers in emerging markets manage the transition to rebuilding monetary and fiscal policy space, macroprudential and capital flow measures may continue to play a complementary role where conventional monetary management proves insufficient to address specific financial stability issues. Liquidity trends should also be monitored carefully, and further analysis of the link between unconventional monetary policy and global liquidity measures is needed. There are also concerns that when balance sheet repair is complete, the previous intermediation channels could result in a rapid resumption in worldwide lending. Indeed, in an environment of low returns, there are a few tentative signs of renewed interest in structured credit products. This suggests that conditions for funding with non-core liabilities may soon improve. To a certain extent, a revival of credit would be welcome. This would be the upside for major advanced economies. However, a surge in global liquidity could complicate policymaking for countries already above absorption capacity and may present challenges for the maintenance of financial stability in countries facing large and volatile capital inflows. This will require continued vigilance by central banks globally. So I hope that over the next 2 days, your analysis and policy experience can shed lights on these issues and other related points. And I look forward to the outcome of this conference. Thank you very much for your attention.